Good day everyone! I am filming this video for my laboratory exercise 7 for Management Accounting 2. Let us read the questions. Question number 1. How do differences in production and sales level affect income under absorption and variable costing? Question number 2. Explain why either absorption or variable costing is best for a company to use as their costing system for internal decision making. Why do many firms maintain accounting records under both systems? Number 3. Chris Gatan, president of Vid Village, has heard about operating leverage and asked you to explain this term. What is operating leverage? How does a company increase its operating leverage? For question number 1, first, let us have the definitions of absorption costing and variable costing. In absorption costing, we consider all the costs associated with the manufacturing of product. Fixed overhead and variable manufacturing costs are included in the calculation. For example, these are the direct and indirect costs such as direct materials, direct labor, rent, and insurance. It calculates a per unit cost of fixed overhead. Meanwhile, in variable costing, only variable costs are considered in the cost of a product. The fixed overhead cost or expense as a lump sum in a period in which they occur. Now, how do differences in production and sales affect the income? In absorption costing, income is influenced by changes in unit sales and units of production. Producing more units, whether those are sold or not, can increase the net income. Because fixed costs are spread across all the units manufactured, the unit fixed cost will decrease as more items are produced. Therefore, as production increases, net income also increases because fixed portion of the cost of goods sold will decrease. Also, since absorption costing takes into account all the cost of production, including fixed costs, it can track the profit more accurately in an accounting period. As per the disadvantage, absorption costing might not be favorable compared to variable costing when management is calculating or making incremental pricing decision. Using absorption costing can inflate companies' profitability in an accounting period because all the fixed costs are not deducted in the revenues unless all the units manufactured are sold. In variable costing, income is affected by changes in unit sales. It does not matter about the units produced. So, when the sales go up, the operating income also goes up and vice versa. Variable costing will result in a lower break-even price per unit using cost of goods sold. It results in gross profit that will be slightly higher. Moving forward to question number 2, a company can use either one or both systems for internal decision making. In absorption costing, as I mentioned earlier, it tracks profits more accurately than the variable costing because it takes both variable and fixed cost of production into consideration. Moreover, absorption costing is in compliance with generally accepted accounting principle or GAAP. Meanwhile, in variable costing, when there is inventory, it experiences less cost changes during an accounting period. So it helps in easier profit reporting through multiple accounting periods. It is easier to forecast cost when production increase. Further, variable cost helps in comparing product lines' profitability as the fixed costs are calculated separately. Variable costing is not allowed for external reporting because it does not follow GAAP's matching principle. Related expenses are not recognized in the same period as related revenue, like fixed overhead. Hence, usually companies prefer to use variable costing for internal purposes or internal decision-making purposes and absorption costing for external decision-making purposes. Proceeding to our third question, let us define operating leverage. It is a cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing revenue. This is a measure of operating risk. The higher the degree of operating leverage, the greater the potential danger from forecasting risk, in which a relatively small error in forecasting sales can be magnified into large errors in cash flow projections. Companies having a high amount of fixed costs tend to have high operating leverages, and companies who are having less amount of fixed costs tend to have lesser or lower operating leverages. Operating leverage measures the relationship between sales and earning before interest and tax, or EBIT. The operating leverage can be calculated as percentage change in EBIT divided by the percentage change in sales. Please note, to calculate the EBIT, you have to less the fixed costs from the contribution margin. Therefore, the other formula that we can use to calculate operating leverage is operating leverage equals to contribution margin divided by EBIT. So these are my answers to the questions based on my understanding. I hope I answered everything correctly and clearly. Thank you and have a good day.